Where we have employment-related securities, and that means employees or directors who are issued shares or they have share options, if they are employment-related and they're readily convertible, then any income tax needs to be assessed to PAYE and national insurance. If they weren't readily convertible assets, but they're just employment-related securities, the employee would just have to declare it on their tax return and pay income tax. The definition of readily convertible assets is in IT per section 702. The easy one is if they're listed shares or securities. So if they're listed on the London Stock Exchange or the New York Stock Exchange, they will be readily convertible assets. They're also readily convertible though, and this is where more of our advisory work comes in. If there are trading arrangements in place at the time of the chargeable event, or even if there are trading arrangements likely to come into place. And that's where the waters are a bit muddied, because if trading arrangements could come into place is a little bit subjective and we need to base it on the facts. A case we've had recently involved a share transfer between two shareholders, but it was as part of a settlement agreement for the exiting shareholders also leaving their employment. What happened was they started talking about the settlement agreement and finally actually completed the share transfer in March 24. They'd already started talking to a potential buyer in January 24, and there were heads of terms signed in May 24. So the transfer of shares between the two shareholders fell right in the middle of those two transactions. Then the actual deal went through. The sale of the entire company happened in July. Our question was, are these readily convertible assets? Because there was an income tax charge due on the transfer between the two shareholders. Our answer was yes, because even if trading arrangements weren't in place because the heads of terms hadn't been signed and there were still technically negotiations, it was very clear looking at all the facts of this case that trading arrangements were definitely coming into place and in the very near future because of how far down the road they were with negotiations. So that was quite clear. Where it got a little bit more confused is section 702 sub 2 talks about the expense that would be incurred by the company in issuing the shares. Well, in our case, we had two shareholders transferring them between each other, and therefore there's no expense incurred by the company. And therefore we had to consider the opportunity cost, i.e. what is the loss to the employer of not being able to issue those shares directly to the shareholder in exchange for cash. And that's how we calculated the market value in this instance.